Okay, so let's start off. We are going to be discussing about the two accounting standards, which is IAS 20, the government grants, and the IAS 23, borrowing cost. So let's start discussing about this IAS 20, which is the government grant. So IAS 20, government grant, let's have a discussion about it. First of all, if I talk about the government grant, so you need to understand that what exactly do mean by a government grant. So government grant is basically the concept behind government grant is that there are many responsibilities of the governments. I repeat, there are many responsibilities of the governments. What are those different responsibilities of the government? Maybe amongst the various responsibilities of the government that includes that the government has to develop schools, the government has to develop hospitals, the government has to develop roads, the government has to set up the power plants, the government has to set up the sewerage lines, etc., etc., etc. But generally speaking, what happens is the government is short of resources. What do we mean by government being short of resources? So the government is usually short of resources, and those resources could be time, those resources could be money, those resources could be HR, those resources could be the technology, etc., etc., etc. So the government could be short of resources, and because of this the government might not be able to fulfill its responsibilities of setting up schools, of setting up hospitals, of actually preparing the roads or setting up power plants or installation of the sewerage lines, etc., etc., etc. So in order to ensure that the responsibilities that the government has, those responsibilities are fulfilled, so the government encourages the private sector to come and invest. And when the government encourages private sector to come and invest, so the government incentivizes them. The government incentivizes them. So whenever the government gives an incentive to them, that government incentives is considered to be the government grant. That government incentive is considered to be the government grant. So when we'll be talking about the IAS 20, the IAS 20 mainly talks about the government grant. What does IAS 20 talks about? It talks about majorly the government grant, that what exactly are the government grants. So now the concept is you to understand that the government grants are what? The government grants are the benefits. Those benefits could be monetary. Those benefits could be non-monetary. Those benefits could be monetary. Those benefits could be non-monetary, which are provided by the government. They are provided by the government. They are provided by the government. Um, they are provided by the government. So um, on the fulfillment of certain task, or on or subject to certain conditions. So when we talk about the government grant, always remember this thing in mind, that the government grant are the benefits which are monetary, which are non-monetary, which are being provided by the government on the fulfillment of certain tasks, or they may be subject to certain conditions, etc., etc. That's what the government grant are. Now, what is by default the accounting treatment of these government grant going to be? So when we talk about the default accounting treatment of the government grant, the default accounting treatment of the government grant is you need to recognize these government grants as income. I repeat, when we talk about the default accounting treatment of the government grant, the default accounting treatment of the government grant is you have to recognize these government grant as income. Now, the question mark that arises is how should we be recognizing these government grant as income? So it actually depends upon whether the grants that are being provided to you, are those grants unconditional grants, or are those grants conditional grants? So I repeat, what happens is when we talk about that the government grants are to be recognized as income, so it actually depends upon whether the grants that have been given to you are those unconditional or are those conditional grants. When we talk about the grants being unconditional, the unconditional means no conditions are attached. The unconditional means no conditions are attached. So if you have got grants which are unconditional, so in that case, what would happen is you would immediately recognize grant as income. You would immediately recognize the grant as income. So I repeat, whenever you've got unconditional government grants, so the unconditional government grants are actually going to be recognized as income. Why? Because there are no conditions attached to it. Because there are no conditions attached to it. And when we talk about the conditional grant, so basically the concept of this conditional grant is that when the conditions are attached to these grants, when the conditions are attached to these grants, so whenever the conditions are attached to these grant, that is going to be considered as a conditional grant. And with respect to the conditional grant, we recognize it as income. Recognize as income over the period when conditions are met. So over the period when the conditions are met, you recognize this grant as an income. So I repeat, what could happen is you've got a conditional grant, you've got an unconditional grant. When we talk about the concept of conditional grant, the conditional grant is when the conditions are attached to the achievement of the grant, and the unconditional grant is when no conditions are attached to it. How do we treat the conditional grant? The conditional grant is recognized as income over the period when the conditions are met. What about the unconditional grant? The unconditional grant is immediately recognized as an income. That is what you do it. Now, there's further classification of the grants. And what is that further classification of the grants? So what happens is the grants could be further classified into the asset related grant, and the other one of them is considered to be income related grant. So I repeat, the grants could be further categorized into the asset related and into the income related grant. So when we talk about the grants to be asset related or income related grant, what exactly do we mean by these asset related and income related grant? Let's talk about it. So when we talk about the asset related grant, the concept of asset related grant is this grant is being provided to you for the acquisition, for the installation, for the upgradation of an asset. So if you are being paid a grant for the acquisition or for the installation or for the upgradation of the asset, that is going to be considered as asset related grant. So I repeat, that is going to be considered as asset related grant. Now, what next is there? Let's move a bit forward. And what exactly do we mean by income related grant? So when we talk about the income related grant, the concept of income related grant is, as per the definition of IAS 20, it's any grant other than asset related grant. So if you are being given any grant in which the condition is not to install an asset, the condition is not to upgrade an asset, the condition is not to acquire an asset, such a grant is going to be considered as what? Income related grant. I repeat, such a grant is going to be considered as what? Income related grant. So what exactly is this income related grant? It's any grant other than the asset related grant. For example, there is a specific area where there is a hospital situated, and the government has told you that anyone who is going to run this hospital, run and manage the hospital, the government has already constructed the hospital. All that you have to do is that you have to run and manage the hospital. So anyone who is going to run and manage the hospital, we are going to reimburse 30% of your cost. So if the government is going to reimburse 30% of your cost, so that is going to be considered as income related grant. What is it going to be considered as? Income related grant. Is that okay? Now, now let's move a bit forward and let's discuss further. So we have talked about it that there could be an asset related grant and there could be an income related grant. So the asset related grant is for the acquisition, is for the construction, it's for the installation, it's for the upgradation of an asset that is going to be considered as asset related grant. Now what next is there? The next situation is the income related grant. And the income related grant is any grant which is other than, I repeat, the income related grant is any grant which is other than the asset related grant that is going to be considered as income related grant. Now let's move a bit forward and discuss further. How exactly are we going to be, I repeat, how exactly are we going to be accounting for this asset related and the income related grant? So when we talk about the accounting for the asset related grant, so as per IAS 20, there are two ways to account for the asset related grant. And what are those two ways to account for the asset related grant? One of them is you can actually deduct it from the cost of asset. Alternatively, okay, Ademola, I'm going to repeat. I just repeated that the asset related grant is DOET grant, which is being paid by the government to you on the acquisition or on the construction or on the installation of an asset that is going to be considered as asset related grant. That is going to be considered as asset related grant. Let's move a bit forward. The next thing is, how would you treat the asset related grant? So I told you people that as per the IFRS, there are actually two treatments of the asset related grant. And what are those two methods of dealing with the asset related grant? One of them is, when we talk about the asset related grant, it's either deducted from the cost of asset or it's actually recognized as income. As the asset is used, it's recognized as income as the asset is used. So basically what happens is there are two types of grant. I repeat, one of them is asset related, one of them is income related grant. With respect to the asset related grant, we have discussed this thing that the asset related grant is going to be recognized as either a deduction from the cost of the asset, or it is going to be recognized as what? It is going to be recognized as 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 basically an income over the period when the asset is going to be utilized. Now, what next is there? So I'm going to illustrate this to you people through an example. I repeat, I'm going to illustrate this to you people through an example. Assume that there is an asset, the cost of which is $1 million. And from the government, what have you got? You've got a grant from the government of $200,000. The life of this asset is, let's say, the life of the asset is 5 years. Now, how exactly am I going to be accounting for this grant? One of the ways of doing it is that you would simply say that the cash is going to be debited by 200,000 and you would say the non-current asset would be credited by 200,000. So what are you going to do? You're going to say the cash is going to be debited by 200,000. The non-current asset is going to be credited by 200,000. And then subsequently what happens is the remaining net book value of the asset is 1 million less 0.2 million. So gives you 800,000. That is going to be the remaining carrying amount of the asset. And the remaining carrying amount of the asset has to be depreciated over a period of 5 years. And if it is going to be depreciated over a period of 5 years, that means the depreciation expense that you are going to be recognizing every year, that is going to be 160,000. I repeat, the depreciation expense that you would be recognizing every year, that is going to be what? 160,000. So that is one of the approaches where you actually deduct the cost, this government grant from the cost of the asset. Now, what next is there? The next situation is, I repeat, the next situation is the second thing that you could do is that, okay, the cost of the asset is 1 million. The cost of the asset is $1 million. Now, alternatively, what you could do is that you could simply say that the cash is going to be debited by 200,000 and you would be recognizing the government grant as a liability at 200,000. You would be recognizing cash as debited by 200,000 and you would be recognizing the government grant as a liability of 200,000. So I repeat, what happens is you would be recognizing the cash debit and the government grant as a liability of 200,000. Now what next is there? The next situation is every year there is going to be a depreciation. How much? 1 million divided by 5, which gives you 200,000 as the depreciation expense. And what would you do? You would transfer this government grant of 200,000. So, I mean, like one of the entry is going to be the depreciation expense debited by 200,000 and the accumulated depreciation is going to be credited by 200,000. And the second thing that is going to happen is there's going to be the amortization of grant. There's going to be amortization of grant. How is this amortization of grant going to be? It's 200,000 divided by 5 gives you 40,000 every year. So what are you going to do? What are you going to do? You're going to simply say every year you're going to be recognizing an entry like this, which is going to be, you would say government grant, which is actually a liability that needs to be debited by 40,000 and you would recognize an income by 40,000. So hence, if you try to look at this, you would realize that in the profit and loss account, what is actually happening is you're recognizing depreciation of 200,000 and there is an other income of 40,000 that you are recognizing. So end of the day, the net expense to be recognized in the P&L is 160,000. The net expense to be recognized in the P&L is 160,000. So if I talk about the government grant and its accounting, the government grant and its accounting for the asset related grant is that one of them is either it is deducted from the cost of the asset, which we did it here, or what happens is you have to actually transfer it to the P&L as an income over the period of time that the asset is utilized. Imran Makbul, if there is a residual value of the asset, you have to consider it after deducting the grant for depreciation charge. Okay, there is a question that when we have to pay back the grant, when condition is not met, how will we treat it? Just wait for it. Okay, see, what happens is, Edemola, try to understand this thing. I told you people that if you are going to be accounting for the government grant, there are two ways. One of them is either you deduct it from the cost of asset. The other one of them is you recognize it as income as the asset is used. There was an asset which had a cost of 1 million. The grant of 200,000 was earned and the life was 5 years. So what actually happened was, if I deducted from the cost of the asset, so resultingly my carrying amount is going to be 800,000. The life is going to be 5 years. And the depreciation is going to be 160,000 every year. The second thing is, alternatively, what could happen is you could say cash debit by 200,000. The government grant is going to be credited by 200,000 and this government grant of 200,000 would be shown as a liability. Subsequently, what is going to happen is you would say depreciation of 200,000 every year. Why? 1 million is the cost. And there's this amortization of the grant. What is this amortization of the grant? This is actually transferring of the grant from the liability into the P&L. The transferring of the grant from the liability into the P&L. So what are you going to do? 200,000 divided by 5 is equivalent to 40,000. So it simply say government grant debit by 40,000, income credit by 40,000. Are you people okay with these two methods? Are you able to understand these two methods? Amna Mohsen, with respect to the residual value, just ignore it. Just ignore it. You just have to treat it in a normal manner as we do You just have to treat it in a normal manner as we do for the normal depreciation. Is that okay now? Okay, now let's move a bit forward. Okay, Usman, it depends upon how the company wants to go about. No, why would you reduce the residual value first? I mean, just like if assume that there is a residual value of 100,000, the depreciation would have been 800,000 minus 100,000 divided by 5 years. Now, let's move a bit forward and let's talk about it. Okay, let's move a bit forward. Clarity. So, did you say that between the two methods we have to deduct one from the cost of the asset and the other is to reckon? Yes, this is how it is. This is how it is. Okay, now let's move a bit forward. Now the next thing is the income related grant. How exactly do we treat this income related grant? Let's try to understand this. When we talk about the income related grant, there are again two ways of dealing with the income related grant. And what are those two ways of dealing with the income related grant? One of them is you either deduct from related cost or recognize as income over the period when conditions are met. So when we talk about the income related grant, what do you do? With respect to the income related grant, you either deduct it from the related cost, or alternatively, what you could do is that you could recognize this as income over the period when the conditions are met. Now let's try to have an understanding. Let's try to have a discussion. Basically what happens is, I told you that the income related grant is any grant other than the asset related grant. This is as per the definition of IAS 20. Now, I gave you an example also that, for example, there is a hospital in an area which the government has constructed, which the government has built up. And what the government wants is government wants somebody to operate that hospital. So if the government wants somebody to operate that hospital, and the government has told you that anyone who's going to operate the hospital, what we would do is that we would reimburse to you an X amount of. What the government has said is that we are going to reimburse to you an X amount of money from whatever the expenditure that you incur. So that is going to be considered as what? That is going to be considered as income related grant. So how would you do it? Either deduct it from the cost of related asset. So for example, you are being provided with a grant of, let's say, 100,000, and the conditions attached to the grant are of 5 years. So what you do is that the amortization of the grant is going to be like this. The amortization of grant is going to be like this: 100,000 divided by 5, which is going to be 20,000 per year. That is what the amortization of grant is going to be. Now, first of all, what we have done is we have said that cash debited by 100,000 and the government grant is going to be credited by 100,000. So one thing is cash is going to be debited by 100,000 and the government grant is going to be credited by 100,000. Now what next is there? The next situation is every year, you would say the government grant is going to be debited by 20,000 and it's either going to be the expense or it's going to be the other income which is going to be credited by 20,000. Like for example, in one of the methods you would say that the running cost of hospital, assume that 400,000 is the running cost of hospital, and if you've got a grant of 20,000, so you would say 380,000 as this. Or alternatively, you would say running cost of hospital is 400,000 and you would have what? You would have the other incomes of 20,000 shown separate. So these are the two methods that you can adopt with respect to the recognition of, I repeat, these are the two methods that you can adopt with respect to the recognition of income related grant. Kindly go through them and kindly confirm to me that you people are okay with it. You would say running cost of hospital is 400,000 and you would have what? Yes, Zoeb, your understanding is clear. There are students asking questions about what is the treatment. Let me repeat. I told you people that whenever you have got income related grant, you would present it like this. Either you would deduct it from the related cost or you would show it separately as an income. I took an example that you receive a grant of $100,000 with a condition attached to it of 5 years. So every year there is going to be an amortization of 20,000 for the grant. And the way you're going to recognize it initially is cash debit 100,000 and the government grant credit by 100,000. Now, every year what would happen is the government grant is going to be debited by 20,000 and either the expenses are going to be reduced or you would show them as another income by 20,000. So what do we mean by this? For example, if you are being given the grant for running the hospital, so the cost of running the hospital is 400,000. The grant provided is 20,000. So 380,000 is going to be the net cost of running the hospital. I repeat, 380,000 is going to be the net cost of running the hospital. The next thing is either you show it like this, or the other thing is you show the whole running cost of 400,000. I repeat, the other thing is you show the whole running cost of 400,000 and you show other income of 20,000. You get it now? You get it now? Yeah, is that okay now? Okay. Yes, yes, yes. That's how it is. Okay, now let's move a bit forward and discuss further. Um, the next thing is there were students who were asking for it, that what is going to be the treatment in case if we are required to repay the grant. Now try to understand this thing. Maybe possible what happens is you have got a grant and there's a condition of 5 year attached to the in order for you to be able to earn the grant. And what happens is after 2 years you are unable to meet the condition and the government requires you the repayment of the grant. So now that the question mark that arises is that how exactly is going to be the repayment of grant accounted for. So how exactly the repayment of the grant is going to be accounted for. So for this, we are going to go through this section number 32 of IAS 20. What does it say? It says a government grant that becomes repayable shall be accounted for as a change in accounting estimate. That is, you originally estimated that you will earn it. You originally estimated that the conditions will be met, but unfortunately, the conditions are not met. So that means your estimate has gone wrong. So what does it say? It says repayment of grant related to income shall be applied first against any unamortized deferred credit recognized in respect of the grant. To the extent that repayment exceeds any such deferred credit or when no deferred credit exists, repayment shall be recognized immediately in the profit or loss account. So let's try to deal it firstly for the grant related to income. So what does IAS say? The IFRS says that in case if it's an income related grant. What does IFRS say? If it's in case income related grant, so what do you need to do? With respect to the income related grant, what you need to do is that you need to assume that the grant that you were being given was 100,000 and the condition was imposed for 5 years. 2 years have passed. 2 years have passed. So resultingly what happens is unearned grant is going to be what? 100,000 minus 20,000, which is going to be earned every year, multiply by 2. So resultingly 60,000 is going to be unearned grant. I repeat, 60,000 is going to be unearned grant. So that's something that you have to keep in mind, that 60,000 is going to be what? Unearned grant. Now let's move a bit forward and discuss further. The next thing is, now what happens is, now assume that the repayment amount, assume that the repayment amount is case number 1, the repayment amount is 100,000. Case number 2, the repayment amount is 60,000. Case number 3, the repayment amount is 45,000. So I would tell you that how exactly are you going to be accounting for this repayment under all these 3 circumstances? Okay. Now in case if you have to repay 100,000, so what is actually going to happen is you would say cash credited by 100,000. The government grant which was being shown as a liability of 60,000, it would be debited and you would be recognizing a loss in the P&L of 40,000. And you would be recognizing a loss in the P&L of what? You'd be recognizing a loss of 40,000 in the P&L. Similarly, if you are required to repay 60,000, then you would say cash credited by 60,000 and the government grant is going to be debited by 60,000 and the government grant is going to be debited by 60,000. Now what next is there? The next situation is, in case you have not met the conditions, but 45,000 of the government grant is required to be repaid. So if 45,000 of the government grant is required to be repaid, so how exactly are we going to be accounting for it? We're simply going to do it like this. We're going to say cash credited by 45,000. The government grant is going to be debited by 60,000 and you would now be recognizing an income of 15,000. You would now be recognizing an income of 15,000. So this is how you'll be doing it. I repeat, this is how you will be doing it, which is that the government grant is going to be debited by 60,000. The cash is going to be credited by 45,000 and the P&L is going to be credited by 15,000. That's how you're going to be doing it. Okay, so that's basically when you've got a grant which is income related grant, and if the income related grant is being repaid, so this is how you're going to do that. To the extent that the grant is available, so you would be debiting the unearned grant, and if the payment exceeds the unrecognized grant, then that has to be recognized as an expense in the P&L. And if the whole amount is not repayable, then the balance amount is to be recognized as an income. Okay, Ademola, when you are asking that what is unearned grant, so you see 100,000 was the grant that you received, and it was supposed to be earned over a period of 5 years. And what actually happens is only 2 years have passed. That means 60,000 is unearned grant. Imran Makbul, I'm not teaching this asset related grant. I'm talking about the income related grant right now. Okay, Miss Bongi, you are saying we have earned. Okay, now you explained to him. Okay, now no, you don't reverse the grant. You see, I've explained to you people three treatments. You see, it has to be treated as a change in accounting estimate, and the change in accounting estimate has to be dealt with prospectively. It has to be dealt with prospectively. So the prospective dealing is that you would recognize in current period and in future periods. It's not the historical, it's not the past period. It's either in the current or in the future periods. That's how you recognize it. Okay, now let's move a bit forward. Now, what next is there? The next thing is, it says, for the repayment of the grant related to an asset shall be recognized by increasing the carrying amount of the asset or by reducing the deferred income balance by the amount repayable. The cumulative additional depreciation that would have been recognized in profit or loss to date in the absence of the grant shall be recognized immediately in the profit or loss. Now, how exactly are we going to be recognizing it? How exactly are we going to be recognizing it? Try to understand this. For example, the cost of asset was $500,000 and the grant that was received was $100,000. Life of the asset is 5 years. The grant is repaid at the start of third year. Amount repaid is 100%. Amount repaid is 100%. So now, see what is actually going to happen. There were two ways of dealing with the asset related grant. One of them would have been that you would have simply said that the cost of the asset is 500,000. The government grant is 100,000. So resultingly 400,000 is the remaining carrying amount. And then if there would have been a depreciation of over a period of 5 years, and if we say multiply by 2, so the 2 year depreciation would have been what? 400,000 divided by 5 multiplied by 2, 160,000. So you would have had the carrying amount of the grant to be what? You would have had the carrying amount of the asset to be 240,000 at the end of year 2. This is at the end of year 2. Now, it says that 100% of the grant is repayable. 100% of the grant is repayable. So if the 100% of the grant is repayable, how exactly are we going to do it? We are going to recognize two treatments. First one of them is we're going to say the cost of the asset is going to be debited by 100,000 and the cash is going to be credited by 100,000. So the asset is going to be debited by 100,000 and the cash is going to be credited by 100,000. Now, if we do it this way, then what happens is the carrying amount of the asset was originally 240,000 and then we added up the grant repaid. The grant which was repaid was 100,000, so we added it up. So resultingly what happens is it becomes 3,40,000. I repeat, what happens is it becomes 3,40,000 for us. Now, if it becomes 3,40,000 for us, so the problem over here is we have added up 100,000, the whole of the 100,000, but we have not incorporated the desired depreciation. So what we are going to do is that we are going to say that what would have been its depreciated historical cost. So the depreciated historical cost would have been what? Had there been no grant available, then 500,000 divided by 5 multiplied by 2. So that means 200,000 of the depreciation would have been recognized out of the 500,000. You would have had the carrying amount of 30,000. So that means the extra depreciation that needs to be recognized is of 40,000. So now try to understand. If you had deducted this grant from the cost of the asset, then one thing is going to be you would add up to the cost of asset and you would deduct the extra depreciation that is being charged. Is that okay now? You would recognize this in the P&L. Do you people get it? Okay, let me come again. Now see, the asset was 500,000. The government grant of 100,000 was received. The carrying amount remains 400,000. The depreciation is over a period of 5 years. The 2-year depreciation is 160. The carrying amount is 240,000. Now 100% of the grant is repayable. So you would say cash credit, asset debit 100,000. What are you going to do then? Carrying amount of the asset is 240,000. The grant is repaid of 100,000. So the carrying amount becomes 340,000. But what has happened is we have added up the entire grant, but we have not recognized the depreciation that would have been charged had there been no grant. So had there been no grant, the asset would have had the carrying amount of 500,000 divided by 5 multiplied by 2. The accumulated depreciation would have been 200,000 minus 500,000, 300,000 would have been the carrying amount. And the carrying amount right now is 340. So the additional depreciation of 40,000 is to be recognized in the P&L. Are you people okay now? This amount is to be added to cost of asset. This amount has to be recognized in the P&L. Okay, had there been this case where the income, where it would have been like this, the cash debit by 100,000 and the government grant credit by 100,000, had it been the case like this, what would have been our accounting entry then? If it would have been like this, then our accounting entry would have been like this. We would have said that at the end of second year end, the government grant, which is a liability, is of 60,000. So what we would simply do is that we would say cash credit by 100,000. The government grant is going to be debited by 60,000 and the profit and loss account is going to be debited by 40,000. Do you people get it now? Because 2 years have passed, maybe this is a bit confusing for you. I would say start of third year. Is it okay now? Are you getting it? How did I get 60,000? Are you getting how did I get 60,000 now? Okay. You see, you had an asset of 500,000 and the grant was 100,000. There are two treatments. One of them is you either deducted from the cost of the asset, and the other treatment is you either you either you don't deduct it, but rather you transfer it to the P&L over a period of time. So originally you had booked a liability of 100,000. Over a period of time, this 100,000 liability is going to be slowly, gradually transferred to P&L, 20,000 every year, 20,000 every year. So resultingly what happens is at the start of 30th, 60,000 is remaining. So it's a cash of 100,000 is payable. So 100,000 cash credit, government grant debit 60,000, P&L debit by 40,000. Okay. So with respect to IAS 20 government grant, this is it about IAS 20 government grant. This is how we are going to be accounting for this government grant. I've closed that down. Unfortunately, I've closed that file. I cannot show you right now. I can share it later on. That was the accounting standard. I've closed it right now. So I'll show you later on. Now let's move a bit forward and let's discuss further. We have got some of the questions on IAS 20 government grant. Let's try to have a discussion of these few questions. So the number one of them is, it says Norman has obtained a significant amount of grant income for the development of hotels in Europe. The grants have been received from government bodies and relate to the size of the hotel which has been built by the grant. So what is it? It's an asset related grant that you've received. The intention of the grant income was to create jobs in areas where there was significant unemployment. The grants received of 70 million will have to be repaid if the cost of the building of the hotel is less than 500 million. Now see, what happens is you need to understand this thing, that it says Norman has obtained a significant amount of grant income for the development of hotels in Europe. The grants have been received from government bodies and relate to the size of the hotel which has been built by the grant assistants. The intention of the grant was to create jobs. Don't get confused by reading this word jobs that it's an income related grant. No, it's not an income related grant. It's an asset related grant. It's not an income related grant. It's an asset related grant. Why? Because it's being provided for the building up of the asset, for the building up of this hotel. So it says where there was significant unemployment, the grants received of $70 million will have to be repaid. If the cost of the building hotels is less than $500 million. So what are you going to do? I mean, with respect to this accounting for the grant, if this is a 4-mark requirement, so you would simply say that since the grant is provided to Norman Bay for constructing hotels, therefore this will be treated as an asset related grant. if it is likely that the cost of the building of hotel would be would exceed would exceed this $500 million, then grant income of $70 million can be recognized either by reducing cost of the asset or by recognizing the grant as unearned income and then transferring it over the life of the building to P&L as income. This is how you're going to write down the answer to it. This is how you're going to write down the answer to it. Okay. Now kindly read through it. What is the purpose of this grant? It's for the development of the hotels in Europe. Although you intend to create jobs, but this is not an income related grant. It is not to compensate you for the cost of running the hotel. It's there to compensate you. It's there to incentivize you to build up a hotel there. No. Norman has obtained a significant amount of grant income for the development of hotels in Europe. It's for the development of hotels. The grants have been received from government bodies and they relate to size of the hotel which has been built by grant assistance. So it's actually depending upon that how big a hotel that you construct. It says grant receive of 70 million will have to be repaid if the cost of the building hotel is less than 500 million. Again, it's not pertaining to that how many years you run the hotel, how many jobs you create. No, it's not like this. It's actually upon whether the hotel that you construct is of more than $500 million or not. Don't try to misinterpret it, please. Okay, Akshay, this video is being run live on my YouTube right now. So you can get it from there. Now, let's move a bit forward. Okay, I'll go back to the answer. Malope, just let me know when you are done. Okay, thank you. Now let's move on to the next part of the question. Okay, now see, okay, you're saying that how do we answer if the cost of the building does not exceed 70 million? So you could simply say, in case if the cost of the building is not likely to exceed $500 million, then the grant of $70 million should be recognized as a liability till the time it either becomes repayable or is earned. So it has to be like, you see, your building would get, your construction of the building would end. And once your building has been constructed, then either of these two things can happen. What is it that either of these two things can happen? One of them is either what is actually going to happen is that the cost would exceed 500 million, so you would receive it, or either the cost would not exceed 500 million, so you have to repay it. So it has to be either of them. Okay, now let's move a bit forward. Let's try to attempt this requirement. It says Verge was given a building by a private individual in February 12th. The benefactor included a condition that it must be brought into use as a train museum in the interest of the local community, or the asset or a sum equivalent to the fair value of the asset must be returned. So the Verge was given a building by a private individual in February 12th, and whoever who gave you the building, he laid down a condition that you must bring it into use as a train museum, or else, or else, or else, uh, either the asset or the sum must be returned. The fair value of the asset was 1.5 million in February 12th. Welsh took possession of the building in May 12th. However, it could not utilize the building in accordance with the condition until Feb 13. As the building needed some refurbishment and adaptation, and in order to fulfill the condition, Welsh spent 1 million on refurbishment and adaptation. On 1st July 12, Welsh obtained a cash grant of 250,000 from the government. Part of the grant related to creation of 20 jobs at the train by providing a subsidy of 5,000 per job created. The remainder of the grant related to the capital expenditure on the project. At 31st March, all of the new jobs had been created. So now see, can you people try to do it? I'm giving you 2-3 minutes. Just try to do it. Okay, let's just start off. There are multiple aspects to this specific question. The first one of them is the receipt of building from an individual. So the building is a non-monetary item. How do we recognize this building? This is simply a sort of a donation that you have received. It's simply a sort of a donation that you have received. Now, if I try to recognize the property, plant and equipment, I'll be recognizing it at zero. Why? Because the property, plant and equipment is recognized at cost, and cost is the cash or cash equivalent paid or fair value of other consideration transferred. So we have done neither of them. So on the basis of this, the PP is going to be recognized at zero. Now the second thing is, can it be considered as an income? Yes, it can be considered as an income. So how do we recognize this income? The income is recognized as the fair value of consideration received. So what are you simply going to do? You're going to say the property, plant, equipment debit by 1.5 and income is going to be credited by 1.5. Although it's not a government grant, but it's an income. It's a donation received from somebody. For example, if an organization receives a gift, what is the organization going to do? Will it not recognize it? A gift is an income. A gift is an income, whether that's being provided by government or whether that's be provided by somebody else. It's an income. So although if I look at the recognition of IAS 16, IAS 16 says the cost is the cash or cash equivalents paid or the fair value of other consideration transferred. So as per IAS 16, the cost is going to be zero. But what happens is, if I need to recognize the income because I've got the gain. So if I've got the gain, what is actually going to happen is that the income is going to be recognized of 1.5 and the PP debit by 1.5. The next thing that I need to do with respect to this is that the PPE is going to be debited by 1 million and cash is going to be credited by 1 million. Why? Because you have spent the amount for the refurbishment. You have spent the amount for the refurbishment. So the amount that you have spent for the refurbishment, that needs to be capitalized. Okay, tell me, let me know what is the definition. At what amount do you recognize PP? Yeah, let me know. At what amount do you recognize PP? You recognize PPE at cost. And what is the definition of the cost? Cost is the cash or cash equivalents paid or the fair value of other consideration paid. So we have not paid any consideration. We have not paid any cash. So the cost is zero. Do you get it now? Yeah, Amina, you get it now? Yeah, are you still stuck on this? Please let me know. Okay, I recorded it because I have received this I've received this building free of cost from somebody. So is it not my income? So if you have got an income, if it's my income, I need to book an income. Income is recognized at fair value. So the fair value is 1.5. So if the income is booked at 1.5, so correspondingly there has to be an asset that needs to be recognized. Now, furthermore, you have spent 1 million on the refurbishment. Okay, Vivan Ching, we have not recognized under IAS 20, we have not recognized under IAS 16. It's more of an IFRS 15 that we have applied over here. Because as per the revenue, this is an income that you have booked. So you would be recognizing it as an income. It's more of a conceptual framework that you have to book an income here. Okay, now, so the refurbishment is going to be capitalized PPE debit, cash credit 1 million. Yeah, it's not under IAS 16 that we have booked it. Now, although the PPE is IAS 16, but we did not originally book it under IAS 16 criteria. We rather applied the income definition. We rather applied the definition of the revenue to recognize it. Yeah, we will depreciate it because you have an asset. Okay. Now, the refurbishment is what? PPE debit by 1 million, cash credit by 1 million. Now, what next is there? The next thing is, so we have done first paragraph. The second paragraph needs to be seen. It says on 1st July, you obtained a grant of 250,000 from the government. Part of the grant related to creation of 20 jobs for providing 5,000 per job. The remainder of the grant related to capital expenditure on the project. At 31st March 13, all of the new jobs have been created. So that means what happens is, of the 2,50,000 grant, there is partly asset related grant and there is partly income related grant. When we talk about the income related grant, 20 jobs multiplied by 5,000 gives you 100,000 to be income related. This 150,000 to be asset related grant. So this 100,000 is going to be recognized in the P&L as income because the conditions have been met, the jobs have been created. Because the conditions have been met, the jobs have been created. With respect to this 150,000, you can either deduct it from the cost of the asset or you could recognize it as deferred income. So if I say that I'm recognizing it as a deferred income, so it's 150,000, which is the cash debit, and correspondingly the government grant, which is credited by 150,000 at what? At the date when it was received, which was 1st July 12th. Now, what is the condition? Is there any condition? Okay, the jobs have been created. What else? Is there any condition? Is there life mentioned of this asset? None for the asset related. There is no life mentioned for the asset, right? Okay. So I would rather say that the property, plant, equipment needs to be credited by 150,000. I would rather say that the property, plant, equipment is going to be credited by 150,000 because I have no idea about the life of this asset. And when I don't have the idea about the life of the asset, I cannot specifically say that how much of the grant income can be amortized during the current year. Is that okay now? Okay, so what have we done? We have gone through this IAS 20 government grant and few of the questions pertaining to government grant. So that's all